and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I mean, those bears will come out of hibernation mode today. But the reality is that they're going to produce over 2 million vehicles next year. And when you think about the overall growth story, more penetration on the FSD, now it's just execution. But to poke holes in this story, I believe the most undervalued AI play in the market.
Try to look through all of the data issues, the seasonal adjustments and so on. We basically soft landed almost a year ago. And we're basically been in that place ever since. Any individual rate decision doesn't make that much difference. I mean, the interest rates that matter for economic activity are long-term interest rates, which depend upon the whole expected future course of Fed policy, not on what it did in a particular meeting.
Said at the end of the second quarter that we had turned the corner and we're returning to both revenue and profit growth, and that's what we showed in the third quarter. And it really is the outcome of a lot of effort to focus on revenue quality and growing the business in the segments that really matter to us. So it's a great outcome for us.
We got 1 hour to go until the market close. So let's take a look at the major averages. Let's call it mixed today, Josh. We've got the Dow trading lower by about 194 points or so, about 0.4%. The S&P 500 very slightly higher, 0.1%. The Nasdaq up about 0.5%. So we've been, I've been singing the same from the same hymnal, I guess you could say, during this earnings season, which is that you get days like this where it's really about the individual names reporting earnings. Now, the big one, obviously, reporting today is Tesla. It looks like, if my calculations are correct, it's going to end up having its best single reaction to earnings in the last at least 10 years or something like that, with up this 21%.
And what do you make of that report? Because I know you've been thinking about it and writing about it.
What I've been thinking about the report is that, Tesla is a car company still. Yes, you can buy it and value it for the AI and the robotics and the autonomous driving. But right now, what it does is sell cars. And this was a quarter where it did well selling cars and better than people expected. And so it is being rewarded for that. But we're not seeing a ripple effect from a Tesla.
Yeah, I mean, I agree. I mean, listen, it's better car margins. That was the story.
Yes.
I saw one analyst who covers his name told his clients, he looked at those margins and said they were eye-watering, Julie. And what was interesting is the management said, during Q4, they said they told analysts on the call, investors listening, and don't expect it to be as robust.
Right.
But clearly, investors looking at this and they like the look of this company's fundamentals right here. You see them just piling in.
Yeah, and just to give a couple other examples here of other stocks moving big on earnings that are trending. Gold, Newmont, I should say, which we're going to cover a little bit later. IBM, which reported after the close yesterday, doing very differently than a Tesla, for example, off by 7%. UPS, which we're going to talk more about, up 5%. So you get all these big moves individually that don't necessarily add up to a unified sort of narrative overall. Sorry, I'm going to go backwards here. But there's one other thing that I wanted to mention, and that's what's going on in the bond market. You and I have been watching what's going on in yields very, very carefully. We've been seeing this big move upward in yields. Today, a little bit of relief, a little bit of pause.
A little bit of relief, but what a move. We talked about it. Obviously, this has been front and center for investors. Really important also, knock-on effects. We've talked about it. I checked the 30-year fixed right before I came on. We're back up to 691, according to Mortgage News Daily. And, of course, we have a housing economist coming on the latest show. Help us walk through that.
And here's the 30-year yield as well, which is sort of reference point for this stuff.
All right, for more on the moves today, let's welcome in now Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always great to see you and have you on the show. Maybe start, Steve, listen, it's the mover of the day. It's Tesla. It's ripping higher. What do you make of the move, Steve? More broadly, what are the ripple effects, do you think, the lessons learned for the market here?
Hi, Josh. Well, basically, this is a hard story to poke holes in, and you really can't, which is why the stock is up 20%. And yet again, though, it was not as much that they beat on their current EPS, which is of course very important, but it's that the guidance was really terrific, and they beat in the right ways. Margins expanding, talk of higher sales going forward, double-digit higher sales in the next year. We'll see if that's achievable, but the market, that's what the market wants to hear. And as you played in the Dan Ives clip, there definitely was a lot of bearishness, some skepticism that I noted in the options trading going into this. A lot of times when the options market's a little bit nervous and sketchy, that's when the opposite happens.
I think Tesla's a good example, though, that not all Mag 7 stocks are created equal. I mean, not just because Tesla's been the laggard this year, but because more when you get an Alphabet or Microsoft, maybe you see the rest of the market taking more cues, perhaps. How do you think the rest of the market kind of looks at Tesla?
Tesla's a bit of an outlier at this point. For a while it wasn't, because Tesla had the number one share of the market's mentality, the market psychology. That was probably I broke the history of Tesla up a couple of weeks ago into B, T, and AX, before Twitter and after X. In the before Twitter era, it was the company. And that was it. And it deserved to be. It was up like 20-fold in about 2 years or 3 years or something of that nature. It ought to be. It was NVIDIA on steroids in terms of performance. But since then, it's really, people have started to value it a little more carefully, whether it's because of the Twitter acquisition or whether it's just because of maturation. But as a result, you know what? When you think about it, there's a lot of overlaps between the other stocks. NVIDIA's customers are the other Mag 7 stocks for the most part. Alphabet and Microsoft overlap in many ways. Google and Apple both make phones. So there's a lot more interconnectedness, whether it's more from a competitive basis, but they're sort of all in the same turf there, and Tesla's really not.
Let me ask you a broader question. You said recently something interesting. You said, listen, surfing the wave right now has been working for a lot of folks. Hopefully, you said, it doesn't end in a wipeout. How could it end in a wipeout? I mean, what is on this sort of Steve Sosnick wall of worry?
Well, I mean, I guess, as my life spent as a risk manager, really, that's unfortunately a skill I've honed for years. But what it means is it's often something you don't expect. The geopolitics, we all know what's out there, and quite frankly, we sort of have a sense of what can happen. Yes, I mean, if things really metastasize, and I have a feeling that Israel's hanging out until after the election right now. But that, the Middle East can always flare up, and I hope it doesn't. The election itself can be a bit of a hairy situation. I think right now, although the market sort of has been pricing in some Trump trades, I think the polls are still telling you that it's a coin toss. And, one of the reactions might be, basically the bond market may flip out, if Trump seems to be going through with the idea of his tax policies. On the other hand, if Harris seems committed to not extending the Trump tax cuts, you may see a little of tax selling brought forward rather than kept into next year. So that could be a potential risk too. And then of course there's just the lofty expectations. We've priced in 15% growth for next year, basically, on earnings, and that's a tough thing to reconcile with an economy that's people are clamoring for interest rate cuts. Considering though that the Atlanta Fed's GDP now is 3.4%, something's got to give.
And the economic data we saw today, Steve, I mean,
very strong.
New home sales, initial jobless claims, yeah.
So are you going to get rate cuts in that environment? Yeah, you'll probably get 25 at the next meeting because it's kind of baked in. But going forward, how much are they going to do? And so the markets better figure out. It better lean on the side of the strong economy that can deliver those earnings results rather than sort of hinging upon rate cuts. And if we're hinged too much upon rate cuts, that could be a bit of a disappointment as well.
I'm curious, Steve, what you make of the idea. I'm reading Josh Brown's recent book, and one of the things he's talked about for a while is that there is sort of this vested interest in the market going higher. I mean, that much is obvious, but that it is held by more and more people. In other words, people rely on it for retirement, not depending on Social Security. And so there's this, huge passive income in the market, but also a lot of people like us, right? People like working people in the United States who are buying stocks because they want something to retire on. And that there is that floor under the market that is going to just continue to keep it up. You look skeptical.
Yes, because the problem becomes if everybody starts to worship at the same altar. There's no, it gets too crowded. So if everybody starts to be fully invested in stocks, who's left? Who's the marginal buyer? That's the scary part to me sometimes. But you're right. I mean, you know what? We all should want it to go up. I mean, and it's interesting what happens in terms of my phone calls. On a day like yesterday when we were down, call it 1% on S&P, my phone's buzzing constantly. Why are we down? Why are we down? I don't get any calls when we're up a similar amount because it's supposed to do that. So, and especially in a bull market right now, it does do that much more often. So something seems wrong when we go down, even if that's just normal volatility. I've used the term socially acceptable volatility versus plain old real volatility, but they're the same thing. It's just moving up and down, but we all want it to move up. We all want it to move up. Everybody does. This whole ecosystem is built upon it going up. And so, I think that's why it's helpful to have market-friendly policies all the time, especially as more people, as you say, have come to rely on the stock market as a source of wealth. On the plus side, also, it's created a wealth effect because everybody people feel better when they look at their 401k and it's a bigger number.
They do, and maybe they're more willing to spend. Exactly. Thanks a lot. You are going to stick around, by the way, and we're going to have you back later in the show for Goodbye or Goodbye. We're just getting started here on Market Domination. Coming up, Boeing shares lower today after union workers rejected the latest labor contract proposal. We'll get to the latest and check in on some of our other trending tickers next. Plus, UPS shares are jumping today on the back of their latest earnings report. We've got analyst reaction to the shipping giant later in the hour. And at 3:30, it is indeed the latest edition of our series Goodbye or Goodbye. We're going to take a deeper dive with Steve Sosnick into two stocks to help you make the best moves for your portfolio. Stick around, much more Market Domination still to come.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Elon Musk has repeatedly said that Tesla Energy will eventually be bigger than the company's automotive business. And with each passing quarter, that prediction seems more and more likely to come true eventually. The division reported a record gross margin of 30.5% for the third quarter, and its Powerwall deployments reached record levels for the second quarter in a row. Joining us now to discuss is Jed Dorsheimer, William Blair Group Head of Energy and Sustainability Research Sector. Jed, thanks for being here.
Thanks for having me.
I said eventually there because if you look at the revenue of the company and measure it by that, you know, the energy business is still only about 10%. I mean, this is still vastly an automotive company. So how do you think about Tesla as an energy company, both now and particularly in the future?
Yeah, I don't think it's an either or type of situation. And, you know, if I go back to, you know, we were the bull on Tesla in what I saw before most others in late 2018 is that they were about to go through a transition of going from low volume, high price vehicles to low price, high volume. And that was largely predicated on the Model 3 and building out Shanghai. We see a similar situation developing today with Tesla, just not in autos, but in energy. So the energy problem is much bigger than I think most people understand. I think a lot of people think, hey, this is a battery that's going to attach to my solar panels, or this is the mega pack, which is what makes up most of it, that's going to help a utility. And while those are all true, what we've found is within the grid stability globally is actually getting more and more fragile. And so there's going to be more deployments, particularly as you wind down thermal in terms of coal. You're seeing the use of peaker plants. And so this is an opportunity for Megapack. And as we look at the fact that Tesla sold out in Lathrop, California, and bringing up Shanghai, this is the comparison that I would use to the 3 and Y in terms of the volume. We see an opportunity for this business to really scale and to add a level of profitability that most analysts aren't, I think, are not focused on, or most clients, I think I should say, don't have in their models.
So, Jed, just to put a fine point on this, to make sure I'm understanding you correctly. So, in this energy transition world where we're going to look more to solar, more to things that aren't active all the time, like you can burn coal anytime, right? The sun doesn't shine all the time, and you need that energy storage piece that, say, power companies, utility companies are going to be, or municipal electric grids, for example, are going to be a bigger client of Tesla?
Yeah, and quite frankly, solar is the problem. Solar and wind are the problem. The variability that is created, just as you said, the sun not shining, and we're trying to find remedies to that. But that variability that's put onto the grid, we have to understand how the grid actually operates and how that's split up. And so if you get out of balance, you're going to start blowing up substations. And so there's a need for that to bring resilience, particularly as we put more variability into the system, because the system is not designed for variability since it optimized around dispatchable power. The benefit of fossil fuels is they're dispatchable. And so that difference between marginal and baseload, which is a very important nuance, that gap is going to be filled by megapacks, in our opinion, that is going to be a way to solve this. And that's going to open up a significant amount of demand that I think is well underestimated.
So, Jed, bottom line for investors who are listening right now, the energy side of Tesla's business could add how much to earnings, Jed, by your math?
Sure. We think by 2028, you could see an incremental 235 to 250 of earnings power that is not being factored in right now. And so, you know, that's about could be a third of the overall earnings for the business. You know, maybe it's smaller if some of these other businesses actually outperform more, but, you know, it's a significant portion.
And Jed, who are their main competitors in this area specifically? Is it, say, an Enphase? Is that who they're up against?
No, actually, well, so yes, on the Powerwall, and we cover Enphase actually as well, but the main competitor, so most of the energy business that is driving Tesla's sales right now is the mega pack. So that's more of the utility scale. And so they're going to be competing with Cattle, which is CATL, which is a Chinese company, and then much smaller companies like Affluence Energy. And so this is a pretty open market for Tesla.
Really interesting and important part of the business for people to understand. Jed, thanks for decoding it for us. Appreciate it.
No problem. Happy to. Thank you.
Thank you. Now, time for some of today's top trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, let's talk about Boeing. Those shares down another 1.25% today after factory workers voted to reject a contract offer and continue a more than 5-week strike on Wednesday. Boeing's offer included a 35% raise in wages over the next 4 years. The vote is a major blow to new CEO Kelly Ortberg's plan to shore up the finances of the struggling plane maker. Now, mostly the decline here has to do with the pension benefits that the union had been asking for, but still, you know, there wasn't necessarily a lot of hope that they would approve this, even though their leadership did. But, you know, Boeing not getting any relief.
Yeah, I was reading about 64% of union members who cast ballots, 64% voted against it. But as you know, a setback. Boeing is now, you know, it's had to suspend work, Julie, on its 737, 767, 77 models at this Seattle manufacturing hub for more than a month now, right? Reports showing it's costing the company about $100 million a day in lost revenue. You know, there's this issue, and of course, Boeing, we heard from them this week, they do expect to burn cash next year. Stock down today, it's now down 40% this year.
Yeah, and as we've been hearing from the airline companies as well, many of them are affected by Boeing, and they are also fed up with the situation and would like it all to be resolved.
All right, so apparently to our investors. All right, our next trending ticker, QuantumScape. That stock soaring today after the lithium battery company reporting a Q3 beat on earnings and revealed it has started the production of low volumes of its first B sample cells. So this one is interesting. Nice move, battery startup, and that was the headline that got people's attention. Has begun producing B sample cells, shipping them for automotive customer testing. Described really as a key milestone for the company, and investors reacting.
So important context here. QuantumScape has no revenue. It is a pre-revenue company. So what it has been trying to do is to develop these batteries for the past several years. It went for public in 2020 through a SPAC. So as we know, the reference price for those is $10. It's trading right around $6.56 right now. So, you know, the fact that there's a lot of relief baked into this announcement, but then they have to translate it into beyond the development stage and actually get it to commercial scale.
And to your point,
so they're not there yet.
Huge jump. You're still down about 10% year to date. Yeah.
Exactly. And one more here, we got Newmont Mining that we're watching. That stock's seeing its biggest one-day drop since 2022 after investors soured on earnings results that should suggest the top gold producer is struggling to control mining costs and capitalize on surging bullion prices. Of course, gold's among the best performing metals this year. It's up more than 30% since the start of January. It's hit repeated record highs. Now, Newmont is up this year also. It's up a little less than 20%. So it's not kept pace with gold. You would think, Josh, wouldn't you? Gold miner would be doing great, but it has purchased some new mines, and those new mines, it's pretty costly to get gold out of the ground.
Yeah, I did see, you know, posted its highest quarterly profit in 5 years.
Right.
But Q3 results, you know, they missed on adjusted earnings, costs, revenue. They did apparently spend more to dig up, you know, metals at mines in places like Australia, Canada, Peru. I did see some analyst commentary, you know, that about expectations here elevated as you kind of moved into the print. So perhaps that's playing a role too. First major gold producer to post results though. So you'll get to see what rivals have to say as well.
Yeah, we'll see what's going on with costs at them as well, at the other rivals between higher labor, energy costs, what that's going to look like.
All right. UPS beating estimates for the third quarter. And earlier today, the company's CFO, Brian Dykes, was talking to Yahoo Finance earlier today about the quarter.
I think we said at the end of the second quarter that we had turned the corner and we're returning to both revenue and profit growth, and that's what we showed in the third quarter. And it really is the outcome of a lot of effort to focus on revenue quality and growing the business and the segments that really matter to us. So it's a great outcome for us.
But what can we expect from the shipping company in the coming quarters? Well, from where we're going to bring in now Brandon Oglensky, Senior Equity Research Analyst at Barclays. Brandon, it's good to see you. So UPS reports, stocks popping about 5% here. But let me get your take on the quarter, Brandon. What did you make of the results?
Yeah, Josh, and thanks for having us on. And look, full disclosure, we did downgrade the stock on Monday to underweight, and that's, of course, a relative rating here. But in the quarter actually came in better than what was pretty soft management guidance, especially in their core domestic segment. And that's what investors really care about here. Margins were just well ahead of where they thought they would be. But I think the debate here, because if you saw the stock opened up probably about 10% today, it's up about 4 or 5% now. I think what people are really debating is the path forward, which is really important for UPS. And I just heard the segment, that you had Brian on earlier. For sure, it's good to see this company back to earnings growth, back to a little bit of margin expansion. But keep in mind, there's some big headwinds here long term. Amazon is still their largest customer, and Amazon has a very large delivery network of their own. So there's risk there that as UPS pushes more price, you're just incentivizing your largest customer to really leave the network. And then we would argue, longer term, if you've taken a look at FedEx, that they're merging their express and ground networks in the US. That's going to take time. But as they get more efficient on the asset side, this duopoly between FedEx and UPS, this becomes a competitor getting more efficient, and they're doing it without a union. And we think it's some of the union work rules here that have really, bogged UPS down, as well as their contracted wages and benefits.
So that doesn't seem like a great backdrop then for UPS, despite this earnings beat, in terms of how it's going to be able to do momentum-wise. And it also seems like, listen, these package guys are always reliant on volume, but it seems like right now they're more reliant than ever if they're not getting the price that you're talking about.
Yeah, for sure. And I think that's what we saw this quarter with UPS. At least relative to us, ground volumes came in quite a bit better. I think we're talking high single-digit growth. Now, we are lapping the period last year when UPS had just ratified their new Teamster agreement. There had been some share shift to FedEx and other carriers like the Post Office, just because people were fearful last year of a strike. So it's some easy comps, but the company is winning back share. Unfortunately, we didn't see a lot of yield upside. So it's good to see some of the volume dropping through to the bottom line. But the bigger question here is, the domestic business is about a 7 or 8 or 9% margin here. Management wants to get it, closer to 10 to 12. So what's the pace of that margin improvement? I think that's where people are questioning the outlook into 2025, because if UPS, again, presses really hard on price, then you could see Amazon actually potentially pulling down more volumes next year.
Yeah, Brett, also, I'm curious to get your take. When you saw the UPS report, as well as other reports in your coverage universe, any read-throughs on the consumer here and where they're at, Brandon? I thought it was interesting. The UPS CEO, she was talking about the consumer. She said actually pretty good shape.
Well, we track all the macro indicators like everyone else, retail sales, PCE. The consumer, at least from a macro standpoint, still feels pretty good from our perspective. And we're definitely seeing retailers, get pretty aggressive on imports into the country this year, because we track the port data very closely and international trade. But I think what UPS incrementally said is, look, in the last few weeks, and they've been talking to their customers, planning very closely. I think they said with their top 100 customers, for the next 4 or 5 weeks of peak. And what is that going to look like? And incrementally, they're hearing, look, take down your expectations just a little bit. So I think on the margin, that was part of some of the trepidation today for UPS as well.
And then talk to me about FedEx also. You mentioned FedEx a little bit. They already reported earnings last month, and we heard from them that they were sort of pessimistic, right? So, when you're looking at these two stocks now, do you want to buy either of them, or do you just kind of stay away from the sector entirely?
Well, again, we're not trying to be negative on UPS here, and I'm glad to see the stock up today. But long term, I really do think that this management team, is stuck between a rock and a hard place, between the union and between Amazon as their largest customer, and with the objective to get a lot of price out of the business to drive incremental margins. On the flip side, FedEx, their quarter was even worse than this. If we go back to September, some of that was self-induced, and recall that there's a big post office contract that actually just went to UPS from FedEx. But as we get away from some of these near-term issues, I really like the path forward at FedEx because they are merging these separate pickup and delivery operations in the U.S. If you walk outside today, you'll see a FedEx ground truck and a FedEx Express truck going to the same buildings, doing the same pickups. They're going to reduce that into one pickup in the future. So just think of the ability for them to really leverage that across the whole nation. So we think there's a big cost out opportunity, a big margin opportunity at FedEx, and the stock actually trades cheaper than UPS.
Brandon, in your opinion, election risk for your coverage universe, logistics, transports?
Yeah, I mean, it can go one of two ways, and obviously there's a lot of rhetoric. It's only going to get more intense, I think, in the next week, especially around tariffs. And if one side wins, I guess we could suspect tariffs could go up. Obviously, we wouldn't want to see lower trade volumes because that just has a direct impact on a lot of freight demand, not only for FedEx and UPS, but a lot of the truckers and railroads that we cover. But then again, some of this stuff can just be that, which is rhetoric. So I'm not sure which way we would put the election risk. But one thing's for certain, if we do get lower domestic tax rates for corporates here, that would be kind of ground zero for a lot of my domestic-based businesses.
Brandon, great to have you on the show today. Thanks so much for joining us. Appreciate it.
Thank you.
And coming up, it is the latest edition of our series, Goodbye or Goodbye. We're going to take a deeper dive into two stocks to help you make the best moves for your portfolio. Stick around. Much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're digging into the financial sector after hearing from several banks so far this earnings season. I'm here with Interactive Brokers Chief Strategist Steve Sosnick, who is back with us, doing a double header here today to talk about Goodbye or Goodbye. So, it's interesting, you're sort of breaking the financials down into broad financials and then regional banks. And regional banks is what you think people should be looking at here. Here represented by the KRE, which is the regional banking ETF. Now, this group has already done pretty well over the past year or so. And of course, we are seeing the yield curve steepen to some extent. So we'd like to look at the net interest margin for many of these banks. So why is this good for these guys?
Most banks are in the business of borrowing short and lending long. And so that creates a bit of a mismatch. And so, but if, think about like your deposits, they're borrowing from you on a daily basis. You could redeem them any day. And so the steeper the yield curve, the bigger the differential between what they're borrowing versus what they're lending. And that is definitely helpful to their bottom line.
And more so than, say, a large bank that also gets money from all kinds of other stuff. These are more sort of pure plays on the yield curve?
Exactly. They're much more so. When you hear about like a JP Morgan or Bank of America, they have huge yield curve plays. I mean, their divisions dwarf many of these banks' whole businesses, but they have so many divisions. They have trading division, have custody. Right. There's all these things that the smaller banks just don't do. And so that's why the smaller ones tend to be a purer play.
And let's talk about relative valuation, too. When you look at regionals versus the broader financials, how do they tend to trade relative to each other?
They tend to follow, because these all do sort of use the same playbook of borrow, short, lend, long, they do tend to sort of follow each other. But in terms of performance, they've both been pretty good performers this year. So this is not necessarily, I love one, I hate the other. I like this one more than the other one. And XLF relative to KRE is about as expensive on a price basis as it's been ever. And that includes, not ever, I shouldn't say that, I didn't go back forever, but 5 years. And that includes the Silicon Valley Bank crisis too. So, and so this, XLF has been a terrific performer. KRE has been a good performer. Maybe it's time to sort of shift toward the one that's showing good momentum but hasn't moved as fast.
Well, and you mentioning Silicon Valley Bank reminds me that, in the past couple of years, there have been concerns about some of the stuff on the balance sheets of these regional banks, including commercial real estate.
Yep.
Where are we in that situation?
I'd like to think that we see the light at the end of the tunnel. I'm going to not profess to be a major expert on commercial real estate. That's outside my bailiwick. But I'm hearing fewer and fewer horror stories about commercial real estate. And again, these smaller banks, their commercial real estate lending is dwarfed by what one of the bigger banks does, but this is a much bigger piece of their business. They've lent to a shopping center in whatever their region is, or a small office building, or a set of doctor's offices. So I do think that this kind of business it may be time to give it a little more of a reevaluation and less of a haircut.
Gotcha. And I guess the risk is, if you're not correct on that commercial real estate,
then this whole trade doesn't work.
Okay, well, let's fingers crossed that it works. And so let's get to the flip side of that. We've alluded to it, XLF. Now, as you said, it's not you would be selling this, but you prefer the regionals. Let's talk about why these are not as attractive. The valuation, to your point earlier, is pretty high right now.
Yeah, this has been on a tear. It's trading around all-time highs, which is not necessarily a reason to sell stocks. Again, that's why this is a relative value call more than a buy one short the other. This is maybe move from one to the next, or do some sort of relative value play. But XLF relative to KRE. KRE's been on a good run, XLF has been on a tear. And that's sometimes maybe is why you think to look a little more broadly than just the leaders.
Yeah, speaking of looking more broadly, I mean, one of the things, we talk all the time about how dominant the Mag 7 is in the S&P 500. I didn't realize how dominant just a handful of stocks are in the XLF.
It's very interesting, actually. I've done the work on all the various sectoral ETFs. All with the exception of industrials, they're actually all quite top heavy. XLE is basically Chevron and Exxon. This one, in this case, it's 4 stocks make up about a third of it. Roughly 13% is Berkshire Hathaway. Then you have JP Morgan, which is about 9%. Then you have Visa and MasterCard. That adds up to around 33%. So it's extraordinarily top heavy, and actually not top heavy with banks.
Right. So if you think that you're buying it as exposure to the banks, that's not necessarily
not what's happening
what you're getting.
necessarily.
And then finally, exposure to consumer spending. Now, we have debates on the show all the time. Is a recession happening? Is it not happening? But if you're even a little worried about it, this group could be pretty exposed.
Because of the two stocks I just mentioned, when you have heavy exposure to Visa and MasterCard, and Discover's in there, Capital One's in there, et cetera, if consumers start to put a tighter clamp on their wallets, these stocks could actually be a bit of an underperformer because they're so dependent upon a robust consumer using their credit cards aggressively.
Right, makes sense. All right, and then what could go right for this group? Consumer spending could hold up, and of course, Berkshire. I mean, I guess though, if you're going to think that Buffett's going to remain healthy for years, then you just buy Berkshire Hathaway.
Yeah, and again, this is it's tough to bet against Buffett, right? I mean, so this is why I call it a relative value play.
Yeah.
But because it's really dominated by Berkshire Hathaway. If you want the Berkshire Hathaway exposure, go buy Berkshire Hathaway. But there's so much else going on in here that's not necessarily what people think of in terms of a banking ETF. That's kind of why I think it's important to look for a pure play if that's what you had in mind.
Look at KRE. All right, that relative value play. Thank you so much, Steve.
My
Really
pleasure,
appreciate
Julie.
it. Great to see you. And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
All right, let's check in on a few more trending tickers sponsored by Tasty Trade. Shares of Viking Therapeutics, those are ripping today. Look at that, up about 20%. It's at reporting third quarter earnings. The street, though, sounds like focusing on its upcoming data readout of its obesity shot and pill in November. Team at Truist, who likes this one, by the way, saying its obesity franchise looks, they said, future-proof. We have yet to see anything as promising in competitors' pipelines, Julie. That's what they said.
Yeah, and looking again at those pipelines, that really seems to be what the thing is here. The company is still posting losses. We should say that. And here too is a sort of pre-revenue situation where people are looking for what's coming down the pike as a reason to buy this particular stock.
Yeah, Street loves this name, by the way.
Yeah.
Full stop, 13 buys, 0 holds,
Wow.
0 sales, even as this stock is up a cool 300% this year.
Jeez, wow. Well, we'll see what ends up happening. And then looking at another healthcare company that's trending, Molina Healthcare. That stock is rising after reporting its third quarter earnings. And what makes this notable is it comes in a couple of weeks where we have heard from health insurer after health insurer with dismal results. What makes it even more remarkable is that this is an insurer that is reliant on Medicaid. And what we've been hearing from the Medicaid and Medicare insurers is that those patients are getting less lucrative. They're costing them more. But in the case of Molina, for example, analyst Michael Ha over at Baird says the third quarter was much, much, much better than our three muches, much better than our base case. So expectations were pretty low going into this.
Yeah, better than feared. That
Right,
was a big theme
exactly.
in the notes. Yes. All right, finally, let's take a look at shares of Restaurant Brands International, parent company of Burger King. Chain is taking onions off the menu at 5% of its locations. This is according to Bloomberg. So far, it has no indication of illness, and this comes after, of course, an E. coli outbreak was detected at McDonald's. And again, Julie, these are headlines that are dropping from Burger King. No indications of illness. Does Burger King says affected stores get the onions from a Taylor Farms and did pull onions at 5% of locations. Of course, it's interesting. We talked to an analyst this week, covered McDonald's, and he had cut McDonald's to a neutral. In part, it was a valuation call, but of course, part of it was this story as well. And I remember he talked to us about, part of the reason he went to neutral is because, listen, this isn't a new story for restaurants, but that was kind of his point. It's happened before, and the range of outcomes is enormous, right? Of what it means for a company, its business, how long it goes on for, tremendous.
Yes, in fact, the subject of the chart of the day in today's newsletter, not my chart of the day, but Josh Schaefer's chart of the day, was Chipotle stock and what happened to it following its E. coli outbreak. He talked about how in high school he used to go to Chipotle all the time. The outbreak happened, they stopped going. By the time college rolled around, he started going again, and the stock was
That's it. So is it
recovering.
going to look like that? That's the uncertainty that plays in there.
Right,
So we'll keep
exactly.
watching. Coming up, mortgage rates rising once again. So is the benefit from rate cuts already behind us? And what you need to know if you're looking to buy more market domination is coming up right on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Mortgage rates climbed for the fourth consecutive week, hitting the highest level since August. Rising mortgage rates adding a chill to the housing market after new home sales jumped in September, rising to the highest level in over a year, although existing home sales not doing so great. For a closer look at the housing market as it enters a typically seasonally slow period, we got Realtor.com chief economist Danielle Hale. Danielle, good to see you here. So we continue to say rates move higher, which is not what home buyers or sellers, for that matter, want to see here. How is this all trickling through to the market? Are people just now, after we expected maybe people to come in, they're waiting longer?
Yeah, no, it's interesting that you pointed out the existing home sales numbers against the new home sales figures, because the existing home sales numbers from September actually were for home shoppers who were in the market, when mortgage rates were lower in August and September, and yet they were still pretty lackluster. The new home sales data is for contract signings in September, so maybe a little bit more forward-looking, but still we're seeing very different trends in the existing home market than in the new home sales market. New home sales have held on a bit better. They're at 2019, like pre-pandemic type levels, whereas existing home sales are down at 30-year lows. I think a lot of consumers were expecting mortgage rates to trend down for longer than they have. The economic strength that we've seen in the past couple of job market readings, or really actually only the most recent job market reading, has caused a bit of a rebound in interest rates, including mortgage rates. And so consumers have been a bit caught off guard, and we haven't seen the improvement yet. I think people were waiting for more, and we just haven't seen that yet.
I'm curious, Danielle, the 30-year fix, let's say 12 months from now, what's your latest forecast? Where do you think we could be?
I think we're likely to be not too far off of where we were in September. So low sixes, maybe potentially into the high fives. I do think that's right around the long run normal in this kind of environment where we've got pretty large deficits and some not a great plan to solve that. And we've got the economy that's really chugging along, even though interest rates are high. That suggests that the long run normal rate of interest is a bit higher than potentially it was over the last decade. So I think right around 6% is going to be the long run normal for mortgage rates.
And with that being the case, what does that mean for home prices?
Yeah, I think that's the thing that has been perhaps most surprising, is that home prices have been extraordinarily resilient. We've seen home prices continue to grow. They were up 3% according to the latest existing home sales data. Interestingly, we haven't seen as much price momentum on the new home sales side. So I think that suggests that consumers are a bit sensitive to pricing. But as buyers have pulled back, we've seen existing home sellers also pull back. And so that the fact that supply only just meets demand has kept prices relatively elevated. So I don't think we're going to see a lot of pricing relief unless we add a lot more construction.
Danielle, let's say you're a viewer right now, you're listening, you want to buy a home, you don't want to wait. Any advice, Danielle, tips and tricks about maybe, how can they maximize the likelihood of a lower rate?
Yeah, home shoppers can't control the market, but they can control their personal finances. And there are at least 4 things you can do to improve the individual mortgage rate that you're quoted, regardless of market conditions. You can make sure that you pay down debt so that you have a very good loan to value ratio. You can make a larger down payment to potentially improve that ratio, improve your credit score. You can also grow your income to, again, improve that debt to income ratio. Or for the biggest potential savings, you can actually shop around among lenders, and you're likely to see some variation that you can capitalize on.
That last one is interesting, Danielle, because, even in this market with rates going higher, like what kind of variation can people see if they shop around?
In that study, the variation was up to 0.75%. So that is a pretty substantial savings in any rate environment.
Danielle, we're talking about home prices. What about rents? What are the trends you're seeing there, nationally, regionally?
Yeah, rents have been really interesting. They've been roughly flat nationwide. Regionally, the pattern really varies. So in southern markets, we've seen rents actually fall in some areas. They had really increased over the last couple of years during the pandemic, and we're starting to see some normalization in those areas. Meanwhile, in bigger cities in the Midwest and the Northeast, where in some cases rents are more outright affordable. In other cases, you've got strong job centers and a return to office that's getting people back into the cities. We've actually seen rents grow. Nationwide, though, we've got a bit of stability. It's interesting when we look at the construction data, we've got a pretty large multifamily unit construction in the pipeline. So that means there's a lot of apartments that are still being constructed. If we look at the completion figures, those multifamily units and single family units for that matter, but especially multifamily units are up at very high levels. And so that suggests some additional relief on the rental demand side of, or on the rental supply side of things. So far, rental demand has held up well. So we've kept rental prices roughly flat on a nationwide basis.
And something else you guys have looked at Realtor.com is trends of where people are moving based on their politics, right? Or at least that we don't know if they're really moving according to that, but we know their intentions, I suppose, Danielle. I'm curious how much that's changed over time, if you know, and whether you think some of that will sort of subside after the election.
Yeah, that's interesting. So we took a look at home shopping trends over the last 4 years, and we assumed that people's political preferences aligned with the likelihood that they voted for Republicans or Democrats in the 2020 presidential election, and how those shopping trends suggest that people might have shifted over the last few years. It's interesting, for those out-of-state home shoppers, there's agreement. Everyone likes to move to Florida and Texas. But depending on the areas that you're looking at, we see different trends. And so some states might trend a bit redder, some states might trend a bit bluer. But of course, it's not just the migration trends that matter, it's also shifting opinions. This is certainly not something you can use to predict the election outcomes, but it does remind us that people are not sticking in one place and are willing to vote with their feet, if you will, by potentially moving to a different market.
Danielle, always good to see you. Thanks for joining us.
Thanks for having me.
And while wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We are joined by Jared Blickery to get you up to speed on the action from today's session. We start with the major averages here. The Dow finishing off by 140 points, about 1/3 of 1%. The S&P 500 to the upside by about 1/5 of 1%. And the Nasdaq, the strong one of the day, up 3/4 of 1%. As we've been talking about, not really a huge macro narrative today, although we did see yields back off a little bit, perhaps a little relief there. It really had to do a lot with individual companies and stocks, companies reporting earnings. You know, you see the strength in the Nasdaq with Tesla reporting, for example, and weakness in the Dow from some of the companies, some of the components there. So a very micro-driven day. Jared, what do you got for us?
Yes, I think Tesla accounts for a lot of the action there, and best day for them since May 9th, 2013, so been a minute. And let's tick down to the 10-year T-note yield. Got a little bit of a reprieve today, down 4 basis points, has been higher, in fact, at a multi-month high only a day or 2 days ago, but it is off of those levels, so not really pressuring equity markets as we have seen, allowing the Nasdaq to rise, but not the Dow. Here's the US dollar index, also finishing in the red just slightly, no pressure there. And then if we take a look at the sector action, guess what? The Amazon sector is also the Tesla sector, which is XLY, that's consumer discretionary. That is up 3% and accounting for most of the gains here. Although I would also add that communication services, that's XLC, XLK, that's tech, and XLRE, which is real estate. All of those outperformed the S&P 500 as well. And to the downside, only one sector down more than 1%. That was XLB, that is materials. And here's our leaderboard. Guess what? ARK Innovation Fund, that is at the top, 3.5%. Let's just go straight there because that is another Tesla story. Tesla up almost 22%. Looks like Coinbase also performing or outperforming, up 5%, and UiPath also up about 3% there. And if we take a look at the Nasdaq 100, you're going to see kind of a mixed board, but there are some dark green squares beside Tesla. We have Lam Research up 5%, T-Mobile up 5.7%, and to the downside, we have Honeywell down 5% and Keurig Dr. Pepper down 5% as well. So to sum up Julie's comments, yes, really about earnings today.
Jared, thank you. Appreciate it, buddy. Mixed day for markets with the S&P 500 snapping a 3-day losing streak and some institutional investors getting more cautious. But our next guest says retail investors taking the other side of that trade and getting more bullish. And joining us now is Michael Green, Simplify Asset Management Chief Strategist. Michael, always good to see you.
Yeah, it's great to be here, Josh. Thank you.
Maybe, I thought I'd get your take on the economy here today, because we did get some different data points. New home sales rose. Initial jobless claims fell. I saw business activity expand. What is your take about where we are and where you think we're headed?
Well, we also got the Chicago Financial National Activity Indicator, which was relatively weak, right? And so we have this dichotomy or this divergence effectively that's happening in the economy where many parts of it are relatively weak and other parts of it, particularly those that benefit those who have assets that are earning much higher income, have had a fantastic year in the stock market, are doing relatively well. In particular around things like unemployment claims, et cetera. There's been a very substantive and structural shift in the US employment market around the gig economy, which really didn't exist in the last recession. COVID obviously set aside because of its unusual nature. But what we're actually seeing is we're seeing rising unemployment amongst youth groups. Ironically, that turns out to be the group that really isn't eligible to do things like drive for Uber or DoorDash, et cetera. For insurance reasons, many states limit those who can take those jobs to those over the age of 25. So we see actually kind of a natural experiment in the spread between what's happening in the 16 to 24 category and what's happening in those above. In that 16 to 24 category, we're actually still seeing unemployment extremely elevated. It's up about 400 basis points from its low that it was as recently as June of last year. That's where the economy is weakening. It's really hitting the young people who don't have assets, who are being affected by the much higher borrowing costs, who see their dream of buying a car or see their dream of buying a house getting further and further away from them.
But doesn't that sort of correct itself over time? And you know, typically, you know, we always talk about the differences among different tiers in the economy, but you know, when we watch the market reaction, when we look at the economic data, it's obviously the big average, the big numbers, right? GDP isn't determined by the 16 to 24, by and large. It's determined by the people who are working, who have money.
So again, that's part of the reason why I brought up the Chicago Fed National Activity Indicator, because we're not seeing it all come up roses. But I agree with you with one notable caveat. Economies and individual actions are all about constraints, right? So if I have money in the bank and I lose my job, I don't necessarily have to cut back on my spending. But if I don't have money in the bank, even if I have a job, I might actually find myself suddenly constrained and being forced to trade down. We are absolutely seeing that at the lower end of the economy. We hear this from numerous retailers, restaurants, et cetera, that fast casual space is really being hammered on some of these components. When we actually look at those dynamics, it becomes a question, does it continue or does it heal? And that's what we simply don't know the answer to right now.
Let me ask you what you make of what we're seeing with yields. Michael, obviously front and center for investors. What do you think explains the move we've seen there?
Well, I think part of what we've seen in yields is simply the byproduct of an incredible rally that we actually saw in yields. So we saw 10s move from nearly 5% to about 3.5% over the past, give or take, 6 months. Now we're actually seeing that give itself back after the Fed's cut. That's not particularly unusual. Again, it becomes a question of what happens next. And so I'd mentioned in my communications with you things like the home building sector or the housing sector. Your last guest, I think, was very spot on in saying, look, this backup in yields has actually started to hit the market again. We're starting to see the impact of this, particularly in the existing home markets. I certainly am seeing components of that. And again, it just becomes this question of what happens next is relatively uncertain. We have a very wide choice between Kamala Harris and Donald Trump, between a sweep, between divided government. We simply just don't know a lot of stuff right now. And I think today is a really interesting indication of that, where you have somebody like Tesla, a relatively heavily shorted stock, blowing out earnings or delivering earnings that are well above expectations. The entire space associated with that, the most shorted stocks, et cetera, all rallied sharply today. That tells me there was some real pain felt from the short community.
So put it all together for us, for investors in this market, and kind of taking it back to where we started, which is that there are some institutions now, like a Goldman Sachs, who are saying, that we could see lower returns than we have. There are plenty of banks, though, who say that returns are going to be just fine. And then we have retail investors on the flip side who are still putting a lot of money to work.
Well, I think this is actually part of what's so interesting about it is if you look at the retail perspective, they're absolutely putting money to work. Vanguard conducts a really interesting survey of their investors, asking them what their long-term expectations for equity returns are. Those have actually started to rise, even as Goldman Sachs and frankly Vanguard itself, their strategists are actually projecting 3 to 4% returns out of US equities going forward, well below the averages. But Vanguard customers, having grown accustomed to watching their portfolios rise as rapidly as they have, are now starting to bake in 8, 9, 10% sort of returns into their expectations that ironically are actually hitting like the 95th percentile possible outcomes that the strategists are calling for at the same firms. So there is this wide divergence that seems to be developing in terms of expectations around the stock market. At the end of the day, it's the people with the money that rule, though. So if they're going to continue to pile that money in, if they're going to continue to put it to work, you'll see days like today where things are pushed up.
Michael, when you're talking to your clients right now, what is the number one question you're feeling and getting?
I think the number one question is always about explaining the performance of the stock market, right? People are actually, ironically, not super interested in the economy. They're much more interested in what's going on in the stock market. And I think that's one of the key challenges that we face. As you guys know, I have some heterodox views around how important earnings are or how important valuation is to the stock market. I really think ultimately things like 401k flows, pension flows, et cetera, dominate in terms of the overall behavior. As long as those continue, we should continue to see elements of what we've seen on the course of this year, which is the larger market cap companies continue to benefit, continue to attract the most flows. They are not liquid relative to the size of those flows that are coming in. That's pushing them up higher. Other areas of the market are much more challenged simply because they're subject to inattention.
Michael, always great to see you on set. Appreciate it.
Thank you very much.
And coming up, it's what to watch tomorrow. We're going to tell you everything you need to know to help close out the week strong. Stay tuned. More market domination overtime coming right up. All right, we got breaking news here. Tapestry's merger with Capri Holdings blocked by a judge, which is a victory here for the FTC. Shares of Capri Holdings, look at those. They are plunging on that news. They are down more than 50% right now. Tapestry, parent company of Coach and Kate Spade, while Capri owns Michael Kors. So these headlines just coming in, Julie. A judge has blocked the planned $8.5 billion acquisition by Tapestry of rival Capri. The judge freezed the deal, concluding it would be anti-competitive.
Yeah, and this has been more than a year in the making. This deal was announced back in August of 2023, and we have been waiting for some kind of decision on this. As you mentioned, Tapestry owns Coach, Kate Spade, Stuart Weitzman. Capri owns Versace, Jimmy Choo, and Michael Kors. And the complaint here, or the FTC's objection, has been that this would sort of drive up prices potentially in the handbag market in particular. So it looks like that argument, at least for now, has won out. So we'll see what kind of commentary we get from the companies. Obviously, shareholders very disappointed in this ruling. Well, autonomous agents are emerging as the latest battleground in enterprise AI. Microsoft this week became the latest company to launch AI-driven agents, pitting the tech giant against Salesforce. Our Akiko Fujita joins us with the story and her conversation with the CEO of Salesforce AI. Akiko?
Yeah, Julie, it feels like we can't go a week without hearing about yet another company launching their own AI agents. Salesforce AI CEO Clara Shai has hailed this as the third wave in the AI revolution. Now, specifically, agents are customized digital assistants that are built to tackle multiple tasks at the same time. It can think, come up with a plan of action based on its own reasoning. And that's a significant leap from the traditional chatbots that only responded to pre-programmed questions. We have seen these agents deployed a number of ways. For example, ServiceNow announcing plans to integrate these assistants into its human resources and IT platforms. You had dating app Grindr using this technology to develop an AI wingman that would seek out relationship prospects for you and even set up dates. And in a recent interview, NVIDIA CEO Jensen Huang said he envisions a future where 100 million AI agents would be deployed within the company. Now, the competition between Microsoft and Salesforce is being closely watched, especially because of the sheer scale of enterprise data both companies have. Microsoft CEO Satya Nadella saying earlier this week that AI agents will be as ubiquitous as apps in the future. Salesforce has already launched their agents through a platform known as Agentforce. The digital assistants handle everything from customer returns to helping human sales agents craft their own sales pitch. Shai tells me she believes Salesforce has the upper hand, not just because of the amount of data they have, but because of the quality of that data and Salesforce's ability to build out agents that are unique to each company's needs.
Having specific context about what the AI is trying to get done helps make that AI more accurate. And then you add in all of the information, all the data that we have about who's using it and the customer they're talking to. It gets to a level of personalization where you can actually start to deploy these autonomous agents. It goes from being a single step, prescribing, almost micromanaging what the AI should do, versus asking the agent to figure out what it needs to do. The human supervisor looks at it, and then the agent actually performs those actions. So it's a completely next level of automation.
And you can catch my full conversation with Clara Shai on Lead This Way. That's available on yahoofinance.com as well as our YouTube channel. Salesforce, by the way, is set to make Agentforce more widely available come next week. So guys, expect that competition to heat up even more.
The AI agent wars. Thanks so much, Akiko. Appreciate it. Well, private markets have seen positive momentum as capital allocations from institutions grow. According to McKinsey & Company, undeployed private fund capital has increased to $3.7 trillion, leaving a lot of opportunity within the private market. Here with more on this, Morningstar CEO Kunal Kapoor, Morningstar also just reported earnings. Kunal, thank you so much for joining us. So you're looking at, obviously you guys run a big data business, and part of your data is on public markets, and increasingly a lot of it is on private markets. So talk to me about where you are seeing growth right now.
That's right. We own PitchBook, and so we have a unique vantage point across public, private, and VC. And clearly, if you look through the past few years, the trend has very much been an expansion in the private markets. On your program, too, you've talked about the fact that companies are staying private longer, fewer have IPO'd in recent years, and so the appetite to invest in a swath of companies that previously might have been public but are not for multiple reasons today has increased. Add to that the reality that so much of the debt that is being sourced today is coming from sort of what I'll call non-traditional lenders, at least in the sense that they're not coming from traditional commercial banks. And as that number grows, you have private credit expanding pretty meaningfully as well. And so if you're an investor and you think about your portfolio, it's natural that you're starting to ask questions as to how you can invest in swaths of the market that maybe up to this point were largely available to institutional investors.
And why in broad strokes, why would I want that kind of exposure to private markets, in your opinion? I mean, you could look at the public markets, they seem to be working pretty well for a lot of people right now.
Yeah. And I think that's fine. And I think for a lot of investors, that is probably just fine as well, because there are clearly some downsides investing in private markets, including the fact that you have less liquidity. You clearly have a more complicated tax situation if you're going to invest in private vehicles. But what's changing is that these problems are being solved. And why you might want to invest kind of goes back to my earlier point, which is that there's an increasing concentration of companies in the public markets and an increasing expansion of companies in the private sphere. And so you certainly, to the extent you're interested and you understand what the downsides are, I think it's worth taking a look. And the vehicles are now arriving that will make it easier for the average advisor, for the average investor to start looking at these. But for sure, you're right that you don't have to do it. I think it's just in the context of building a broad, diversified portfolio, it's not a bad idea to be thinking about it.
Where are you seeing the most demand right now, both for data and sort of for asset management services?
Yeah, when I look across, the reality is that there's an insatiable appetite for data. And right before I came on, you were talking to Salesforce executive, and she was mentioning that to train a model, you need the inputs to work, because then the model's reacting to the inputs. And a big part of the inputs is content. And we see demand for more and more content, obviously. But the way we think about it is really through the lens of an investor. And I'll go back to your earlier question about the expansion of private markets. The reality is we build out our data based on what the investor is putting in their portfolios, because we want to demystify the investor portfolio. We want to provide research and ratings on those portfolios. And where we're seeing more and expanding demand is in this convergence between public and private, if you will.
Kunal, another trend we talk a lot about at this show, no surprise, the mega trend of AI. I'm curious how you see that technology impacting investing, both now and what you would forecast ahead.
Yeah, I mean, it's clearly a big deal. It's going to be important. I wouldn't say that anyone has sort of cracked the nut, so to speak, and kind of come up with something revolutionary just yet in the investing space. But I think about it, from the angle of taking away friction and making processes that exist today even faster and better. And so a simple example is generally if someone is, let's say, going into Morningstar.com, they're using a screener to try to determine what their next investment might be. In the future, do you need a screener? I would argue probably not. You can go straight in and interact with the AI chatbot and basically get to the answer that you need in terms of what types of investments you're looking for. And so the ability to take that friction away is going to be great. And I think, too, it's going to bring in more and more folks who've thought that investing is pretty daunting. It's likely to make them investors as well. So while I wouldn't say that there's one revolutionary application today, it's, I think, all about taking away friction so it's easier for people to be investors.
Well, it's interesting that you say that, because I would argue, passive funds have made things less daunting, right? So how would you compare this innovation to that kind of innovation?
Yeah, passive funds have made things less daunting. They've also made things less personal. And I think when you match what we have and the way we're investing in data and you think about the future, The technology is increasingly there for where you and I, whether we use passive, active, what have you, we can then personalize in a more meaningful fashion. So you can take something like the Morningstar US Market Index, and maybe, let's say you work in the financial services sector, and you want a version of that index, but without financial services exposure, because you're so heavily exposed from a human capital perspective. You can start doing that at a very personal level today in a way that you couldn't at scale in the past. And so you're right, the barriers have been lowered, but the barriers to personalizing further and connecting people to their investments are still being lowered.
Kunal, great to have you on the show today. We covered a lot there. Thanks for joining us.
Sounds good. Thanks for having me.
Time now for What to Watch, Friday, October 25th, sponsored by Tasty Trade. Earnings season, it is rolling on. We'll be getting some more earnings from Colgate-Palmolive, AutoNation, and New York Community Bancorp, among others. Colgate-Palmolive announcing third quarter results that's coming before the open. Analysts expecting sluggish sales in the U.S. and China. Investors will listen closely to see if pricing eases with lower interest rates.
Also taking a look at the Federal Reserve, we'll get some more commentary from Boston Fed President Susan Collins in the morning. This coming after comments from Cleveland Fed President Beth Hammack earlier today. Hammack signaling that there's still work to be done to bring inflation down to the Fed's 2% target.
And moving over to the economy, we're going to be getting the final read for consumer sentiment in the morning. Economists forecasting that to tick up 0.2 points to 69.1. New data giving us more insight into the consumer's outlook on the economy.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The S&P 500 snapping a 3-day losing streak thanks to Tesla, the EV maker, soaring more than 20%. Its best one-day performance in over a decade. We've got the trading day takeaways straight ahead. It's a big day here at Yahoo Finance. We're launching a new podcast in partnership with Yahoo Sports, taking a closer look at the intersection of sports and business with Joe Pompliano, and he joins me straight ahead after TKO announced a big deal this morning. And protecting your identity in the age of AI, I speak with one CEO who's trying to do just that as deepfakes are on the rise. Everything you need to know straight ahead. Now, sports is a global multi-billion-dollar industry and a huge part, of course, of people's lives. And money in sports is expansive and increasingly making waves across financial markets. One good or bad business deal or play in the game can make all the difference to your wallet. Now, most people, they know the games, teams, and athletes, but not the money or business behind them. However, one new show wants to change all that. And joining me now is Joe Pompliano, host of Yahoo Finance Sports Report. Joe, it is great to have you on the show, and congrats on your show. I want to dig into that. But first, Joe, let's hit a couple headlines in your world. We heard TKO, the company behind UFC, WWE, buying 3 businesses from the Endeavor Group, including the Professional Bull Riders League. It was for about roughly $3 billion. Joe, walk me through that headline. What did you make of that news?
Yeah, first off, thanks for having me, Josh. But when it comes to Endeavor and TKO, I think this news this morning shocked a lot of people because it kind of seemed like it was out of left field. But when you let it settle for a little bit, I also think it kind of makes a lot of sense. If you think about Endeavor and TKO, they largely share the same management team. They're essentially one and the same company. So what they're doing is they're moving some of the assets from Endeavor over to TKO. And what we know is that Endeavor has been trying to go private now. Silver Lake, the controlling stakeholder in that business, is taking the company private. So they've been trying to spin off or sell or get rid of some of their sports assets. So you have this other company in TKO, which holds the UFC and WWE, and now you're able to move some synergistic businesses over to that asset. If you think about the 3 businesses, On Experiences already does events with the WWE and UFC, so that makes a lot of sense. IMG and their consulting division will be able to help the UFC as they go negotiate a new media rights deal. And the PBR does a bunch of live events, which is very similar to the UFC and WWE. So I think what they're going to do now is they're going to go and say, hey, you guys can go buy these assets from us, $3.25 billion. It makes a lot of sense. We still have a couple other things like tennis tournaments and other stuff like that. We'll bring those to market and go sell those to the highest bidder.
Another, switching gears a bit here, Joe, another story I want your take on quickly. The WNBA Players Union opted out of that current collective bargaining agreement. You know, you could argue that was expected, but I'm curious to get your take on that news. And how do you expect that to actually play out?
Yeah, the WNBA had a fantastic year this year. I think everyone knows that at this point. I mean, viewership, attendance, merchandise sales, sponsorships, everything is up and to the right. And they recently signed a new TV rights deal that's going to be worth about $2.2 billion over the next 11 years. It's a 4 or 5x increase from their previous media rights deal. And what you're seeing is the players saying, we want a bigger slice of the pie. Their average salary right now, if you look at the MVP of the league, Asia Wilson, she's getting paid about $200,000 a year. And Caitlin Clark, who is the primary driver behind a lot of this success, is only getting paid about $75,000 a year. So by opting out of the CBA, they're essentially saying, we want to renegotiate after this next upcoming upcoming season and get a bigger piece. Now, where this gets a little bit complicated is their economic structure. If you look at the WNBA, this business has lost money for a long period of time. I think most people know by now that it's been subsidized by the NBA. They've been paying about a $10 million a year loss every single year for multiple decades. Those losses accelerated to about $40 million this year, primarily because they added this charter jet program. But what that's caused is it's caused this weird division where the trickle down of the money doesn't really flow how you would expect in a normal sports league. So the NBA owns about 60% of the WNBA today. Then they raised some outside capital a couple of years ago, call that another 15%. So WNBA owners only own about 25% of the business today. And that means that less than 40% of total revenue flows down to the WNBA and its players. So my point is very simple. While everything is up and to the right, players probably shouldn't be expecting the raise that would come with that.
Joe, I love both those takes. I appreciate it. Of course, you're not here to just give us the news. You're also here because, as we mentioned, you have a new show here on Yahoo Finance. Let's check out a little of your first episode with former Nike executive Jordan Rogers.
A lot of people have been looking at things that Nike has been doing over the last 6 months, but I want to know what you expect them to do over the next 6 to 12 months.
It seems like the only way they can go up is up from here. They're half of what they were at their peak, I believe. I just looked at it last week. I think they're at $85, $87. Right before I left in 2021, I think they were 166. So I think they can only go up from here. You probably were able to get a bargain on the stock in the last few months while it was down in the depths. So I would expect them to, rise, but we'll see. There's so much that is changing. I'm going to be really interested to see if they're able to evolve to this new landscape that I've just never seen. Often people would ask me, like, who would overtake Nike as a challenger? And I believe if Nike were to suffer or, fall away, it's going to be death by 1,000 paper cuts. It's not going to be some other big player who takes them down. There's just so much option today. There's so much choice. Manufacturing has been democratized in such a fascinating way. And so I think that will be the real challenge to see whether they can weather that storm. But history shows that Nike does bounce back, and they usually bounce back stronger. So if I were a betting man, I would say that they would bounce back.
All right, just a taste of the new show there. Joe, give us an understanding, Joe, when you think about this new show, who's the show for, Joe, and what can viewers expect?
Well, so that's the amazing thing about this show, Josh. Over the last few years, sports have become such a big asset class. I mean, if you look at franchise valuations, player salaries, the endorsement deals that these players are getting, it's now become democratized to the point where I think the average fan cares a lot more about the business behind sports than even some of the executives do that live and breathe sports every single day. So this show is literally for everyone. It's for investors that care about publicly traded sports assets like a Nike or even sports teams. It's for the average sports fan who wants to get a little bit more in depth and in the weeds in the sports franchises that they care the most about. And it's for people like me and you that want a little bit of both of those things. So it's one of those industries that I think has changed a lot over the last few years and is certainly growing and becoming bigger over the coming years as well.
Joe, congrats on the show, and thank you for joining us. Appreciate it.
Thanks, Josh.
First episode of Yahoo Finance Sports Report drops today at 5 p.m. Eastern with a new episode every Thursday. Well, the S&P 500, Nasdaq closing higher, driven by Tesla's post-earnings surge. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Yeah, Josh, we were talking about Tesla yesterday afternoon. I believe the stock was up maybe 8%-ish after hours, and boy, did it take off today. So I want to start with that market action that we saw from Tesla. So you can see here, we're looking at the Nasdaq 100, the Nasdaq Composite, closed up about 0.75% today, but the big move, Josh, driving the Nasdaq, I mean, look at it. It's dark green. It's one of the only numbers in double digits, 21%. Best day for Tesla in over a decade for the stock in single-day performance. What stuck out to me, Josh, from this story was, we've talked about this quite a bit, sort of the fundamental story for Tesla versus the AI robot story, and that kind of being what maybe drives the high valuation. But what stuck out to me is the fundamental story came through in these earnings, right? This was something that a lot of Wall Street analysts were talking about today. We're looking at the adjusted EBITDA margin here, have been tracking down for the past several quarters. Big tick up, a lot more than the street expected. And I was just surprised reading through notes today how happy Wall Street analysts were to see the fundamental story start to come together for this company. Because remember, this is what is driving a lot of Tesla's business right now. A lot of that stuff could come in the future when we talk about autonomous cars, but this is the business right now, and it's very important for that to
it's better car margins. I mean, that was what the street was focused on. And it was interesting, though, on the call when management talked about how, kind of looking ahead, they sort of tempered expectations a little bit, said, Q4, don't expect it to be as robust. But I think, to your point, Josh, you're right. I mean, I think just the street investors, they looked at that report, they looked at the results, and they concluded, you know what, fundamentals are solid, and they bought.
And taking this a step further too, Josh, I have one other chart with us here, one other stat. This is just the earnings reactions. We were talking about this earlier this week, and I want to just point out it's continuing to happen. For companies that beat on earnings and revenue, which Tesla technically didn't beat on revenue, it was close, but we're looking at the current pickup the next day, 2.4%, compared to the average percent would be a little bit under 1. So you're still seeing outsized gains for companies that beat earnings. That's kind of the clear read through right now, heading into next week's big week of earnings. If you're going to get an earnings and a revenue beat, the market seems to like that, at least for now.
Next Schaefer bullet.
You know I love talking about economic data, right? So we got a slew of it this morning. Jobless claims coming off the boil. So remember, we had talked about this pickup here, right? Saw that big tick up there. Economists were saying, hey, we think that might be from a lot of the hurricanes we've been seeing. Maybe the Boeing strikes playing a role in this. Well, we got a number today that solidified that, 227,000, the lowest you've seen in about a month, closer to the trend we were seeing before you had the pickup. So good sign for the labor market there. Then you take a look at the flash PMIs from S&P Global. Also a pretty good sign here. So S&P Global's chief economist, Chris Williamson, highlighting in their release saying, signs like this is saying positive gradual growth for the U.S. economy. He said if you took these numbers and extrapolated into a GDP, that's about 2.5%, of course, over the 2% that people usually watch there. So overall, right now, still looking like soft landing-ish data going into next week, Josh. You know what we got next week? We got GDP, PCE inflation, and a jobs report on Friday. It's going to be a big week for the economy, but this kind of sets the stage for us of steady as she goes going into the big week.
Yeah, so today, I mean, it's interesting, new home sales, initial jobless claims, business activity, and maybe, I mean, is that how we explain, the move we've seen in the yields, right? I mean, is that just improving economic data, and so we're dialing back these Fed cut expectations?
Right now, that is sort of what people are saying, right? We've had multiple strategists on this week saying the move higher in yields is okay for now, right? We're up to 4.2% on the 10-year. That's fine as long as you're getting good economic data. Now, again, that jobs report next week probably tests that narrative, right? You get a really weak print, unemployment rate goes up, people are not going to love that part of, okay, now rates are high, and I'm worried about the labor market again. How does that readjust? So I think it's important for the market to probably see some solid eco data come next week.
All right, Joshua, thank you. Appreciate it. Stick around. More Ask You for a Trend right on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to living not so fabulously.
Hey, 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 it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains, world for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
As AI becomes more advanced in our everyday lives, so too does the threat of cyber attacks from it. That's where a company like Proof comes in, helping with issues like identity verification and fraud detection. For more, we have the founder and CEO of Proof, Pat Kinsella. Pat, it is good to see you. I wanted to learn more, Pat, just to begin a little bit more about the company, because I was reading you started in 2013, and I was interested why you did start this company, Pat. You know, what was the problem you were solving for?
Yeah, so I started this company because I had a bad notary experience, like so many of us had. So I was sold my previous company to Twitter, and as part of that, I needed to get a document notarized, and I went to the UPS store, I got it notarized, I sent it off, and the notary forgot to sign it. And so that sent me down this path, and here we are 10 years later.
And I would imagine, Pat, looking at the company's trajectory, correct me if I'm wrong, I would imagine growth must have surged during COVID. What has it been like post-pandemic?
Yeah, growth did surge during COVID. If you think about it, we sold an alternative to meeting in person, right? So not only did we grow, we moved into the retirement industry, banking, financial services, equipment leasing. So many companies were struggling with the challenges of how do we go digital and how do we still secure our business. Coming out of COVID, we had a lot of customers experience a lot of pain, rising mortgage rates, interest rates in the auto industry, frankly, just a lot of uncertainty. We're seeing generative AI and deepfakes now as a larger accelerant for our business than COVID ever was. And so we're really on the growth path again. And
what do you mean by that, Pat? When you say accelerant?
If you think about what's happening in the world today, it's nearly impossible to trust who you're doing business with. It's trivial to go out and pretend to be someone, to look like them, to falsify documents. And yet the world just went digital, right? And if you look at the adoption rates of banking, of financial services, I could go on and on over the last 5 years, driven by COVID, most companies now predominantly interact with their employees and with their customers online remotely. And so how do they secure these transactions? And so it's become a critical challenge that companies are facing. Deloitte came out with a study projecting $40 billion of fraud over the next 3 years from deepfakes. FinCEN has come out, $81 billion in fraud from impersonation, false records. And so we're purpose-built to solve this problem for companies so they know who they're doing business with is real and that the documents that they've been receiving are unaltered.
And how do you do that, Pat? What's the technology that you're deploying to help companies and customers navigate that risk?
Yeah, so Proof is the first identity authorization network. And so we have a range of products that use identity to help companies determine if they should authorize a transaction, a loan, an account change, a wire withdrawal. We started in online notarization. We're really the company that helped to digitize online notarization. We passed 47 state laws. We did the country's first ever online mortgage, auto sale, estate planning documents. We've been out changing laws, building product, helping people digitize critical transactions. At its core, though, if you think about what a notarization is, you're proving who someone is, you're proving what they've done, and you're creating a record. And so if you think about all these interactions that we're having in society today where you don't know who you're doing business with, we need to prove who they are, we need to prove what someone's done, and we need to create records that can be trusted. So over time, what we've built is all of this workflow so we can be deployed into all these use cases for business and we can solve this critical problem for them.
Who would you consider, Pat, rivals, competitors in this space, and how would you define your competitive advantage in it?
Yeah, I mean, I think there's a lot of companies adjacent to us. I don't know of any that are really trying to solve this core problem. The identity industry has really grown up to solve the KYC AML problem. This is a compliance obligation that's pushed on industry by regulators, and that's really about protecting an organization when someone is opening an account. We're really focused on once you've been entrusted with someone's money. The retirement industry has $30 trillion they need to protect for consumers. There's $30 trillion in home equity that people are trying to steal. Our focus is securing those transactions, and we think we're uniquely positioned to do that. Really born in the notary market, we have a compliance and regulatory first strategy. So our product isn't a vanilla solution that companies need to figure out how to deploy and comply with the law and meet all the requirements. We take that burden on ourselves. We've got more than 4 million different permutations of rules and business logic in our platform. So if you want to do a HELOC in Texas, a mortgage in Florida, a power of attorney in Pennsylvania, our platform knows exactly what to do and how to comply with the law. So you as a business just push the button.
Pat, we mentioned how, Proof's been around for some time now, starting in 2013. What's next for the company? Would an IPO be a possibility?
Yeah, so we are very focused on scaling our current clients and really solving this problem of trust. And so today, we're really thrilled to announce a new product called Verify. The Proof platform has secured more than $350 billion in real estate, $180 billion in financial contracts. And so today with Verify, people can use that core technology so that any member of their team can secure any type of transaction, from account recovery, account takeover, fraud step up. You've heard the crazy stories, the CFO, that wired $20 million, right? So the Verify product that we've now built can serve any of these use cases with all of the technology that's built into our platform. We're also announcing deepfake detection capabilities. And so it's not just that you can detect a deepfake, you can use all of our rich tools to determine the identity of the person that you're interacting with. And again, get back to authorizing the transaction, keeping someone in a digital path, increasing conversion rates, and driving your business. So for us right now, I would say we're still not in a normal market, right? I think all of us were anticipating a really strong Q4 in the real estate industry. It just came out that September was the lowest month for existing home sales in 30 years. And so we like being a private company. We like continuing to invest in our platform. I think for us, something like an IPO is probably 2027 and outward.
All right, Pat, listen, thank you so much for joining the show today. Really appreciate your time.
Appreciate it. Thank you.
Coming up, I'm checking in on a few tickers that are trending after hours. Stick around. More Asking for a Trend right on the other side. Tesla having its best day in over a decade. That's thanks to a strong third quarter. We're taking a closer look at Tesla's revenue in our chart of the day. Yahoo Finance's Julie Hyman is here with more. Julie.
Yeah, and today's chart of the day doing sort of double duty as a preview of tomorrow morning's morning brief newsletter, which you can subscribe to on yahoofinance.com or by scanning the QR code on your screen. And effectively, what was illustrated in this quarter is that Tesla is indeed still a car company. Elon Musk has said repeatedly, don't just value this company, don't just buy this company because it is a car company, buy it because it's an AI and robotics and autonomous driving company, and it will be those things perhaps more down the road. But right now it's a car company, and on that basis, it is doing better than it had been. And there's some hopes perhaps that this is a little bit of an inflection point. We saw automotive gross margins better than estimated. And he's also saying, oh, we'll see 20 to 30% growth next year. Whether you take those projections literally or not, it is clear that the auto business is doing pretty well. And it's still, by and large, by a huge margin, the biggest part of their business. So that's really the subject of today's chart of the day. The purple bars here is auto sales for Tesla. The blue line is service and other, and then you've got yellow or sort of amber here, which is the generation, the energy generation business, the batteries, the energy storage, et cetera. Pretty clear here that you've got these big bars that are autos accounting for about 79% of the company's sales last quarter. Energy generation still only around 10%, but of course, people value Tesla on what they think it will be, not what it is today. One of those folks is Jed Dorsheimer of William Blair, who we spoke to earlier today.
You know, we were the bull on Tesla in what I saw before most others in late 2018 is that they were about to go through a transition of going from low volume, high price vehicles to low price, high volume. And that was largely predicated on the Model 3 and building out Shanghai. We see a similar situation developing today with Tesla, just not in autos, but in energy.
So again here, energy, this little part I've circled, he sees it as a much bigger piece of the pie going forward, Josh.
All right, thank you, Julie. Now let's take a look at what's trending after hours. Taking a look at Decker Brands, the company topping Wall Street expectations for net sales in the second quarter. The UGG and Hoka owner lifting its sales and earnings forecast for fiscal year 2025. CEO Dave Powers saying Hoka and UGG continue to drive robust full price demand in the global marketplace. Let's talk Skechers as well. That stock's surging after the footwear company reported better than expected third quarter results and raised its full year guidance, signaling a robust demand for its products across global markets. The strong performance driven by a 20% increase in wholesale sales, nearly 10% rise in direct-to-consumer sales. And shares of Western Digital rallying after hours. The data storage company posting first quarter earnings that beat analyst estimates. Company also reporting 17% cloud growth for Q1 and saying it expects revenue in the range of $4.2 to $4.4 billion for the next quarter. We're also watching Morgan Stanley. The bank announcing CEO Ted Pick will become chairman on January 1st, 2025. Current chairman and former CEO James Gorman is retiring from the firm at the end of the year as he is set to become chairman of Disney. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.